and want to kind of go through how I use them, and hopefully share a little insight. Very helpful in your own trading, helping you get an understanding of how to work with the markets and hopefully make a little bit of a profit in the process. What you'll often see me do is you'll often see when I'm sitting down for a trading session, you'll see that the market has rallied up, and what I'm doing is I'm waiting for a pullback, and then I'm trying to identify where I'm going to get into the market on that pullback. And so if we look at the market right here, you can see, let's just take a quick look at it. We've rallied up from these lows. If the market's to pull back, what ratio, how far will it pull back? Will it pull back 50%? Will it pull back 28%? Will it pull back 62%? Whatever that is, we're going to use the Fibonacci to kind of give us a guide as to where that market will most likely pull back. And the reason this works is because, as humans, we're kind of wired to see things in ratios. If you think about photography, you've got the golden third rule, where you want to center your subject on 1/3 of your screen. If you look at nature, you've got all of these ratios in nature where things just don't quite look right if they're not balanced in these what they call these ratios, these Fibonacci ratios. And so the same thing works kind of in the market, where if you've got a pullback in the market, where your eyes will naturally look towards is one of these natural ratios that we see, so common in our lives. For example, a 50% retracement, it's very natural for us to look at the market that pulls back 50%. Just because, we look at halves, right? If we're going to go the full way, we look at halfway. If we're going to go a full way, we look at a third. And so it's just kind of the natural way we look at the market. So if you look at what happened here on the screen, gotta find my mouse now. So if you look, I drew those turns in the market before I put these. Let's remove the Fibonacci real quick. Let's do that. We're gonna come on here. We're gonna remove the Fibonacci, and if you'll notice, these are lines that I drew. These are turning points that I drew on the chart before the Fibonacci, before I even applied the Fibonacci to the screen, right? So take note of that. So right here, look at that point, look at that point, and look at that point. So now let's throw a Fibonacci tool on the chart here. And if you look at where I drew those, if you look at where I drew those turning points in the market, I drew them almost exactly right on the Fibonacci numbers. So there was the 50% retracement, so the pullback to 50% and then the rally. Here's a 62% retracement, almost right on the dime. So the reason I do that is to illustrate, these are things that you're looking at naturally. You don't even need the Fibonacci tool on your chart to see these areas. Your eyes will just naturally look towards those areas. And then what's even more impressive about this is if you look back into history, what you're going to see is that those lines very often correlate with support and resistance levels. So let's go back and delete that, click OK, and then let's highlight those areas on a chart, and what you're going to see is that they correlate with resistance and support levels. This is just, again, it's just an interesting thing, it's an interesting phenomena that we see in the market. So you see that the 50% retracement correlated with these highs right in here. the 62% retracement correlated with these lows right here. This is actually another one, but we're gonna kind of discount that one for a minute here. So how do I use these in my trading? So the first thing that I'll be looking for is if this market decides to pull back from this point, where will I expect to see a turn in the market, or where would I expect to see support come in? I could look for an old support or resistance level like this, and I could put that on. But then if I see that that correlates with the Fibonacci retracement, then that strengthens that position. So if this market was to pull back here, and you get this correlation of your Fibonacci's and old support and resistance or resistance, then that's probably a pretty good place. If you watch this market rally down, chances are at some point during that down leg, it's going to hit that level and find some support there, right? Now, that's not to say that that's going to be the exact place where it's going to make its turn and move higher, but it's an area that you look at in your trading to give you an idea of what to do or where to do it. All right, so that's the first rule. When I'm looking, where is this market? If it makes its pullback here, where is it most likely going to stop? So I'll look for it to come to one of those retracements. If you look at this one right here, there's one right here as well. And that's the 22 or 28%. So I'm looking at these levels to see where is it most likely going to find some support on its way down. And then what I'll do is I'll start to build a position at those levels. And so what you'll see me do often is I'll use these Fibonacci levels in conjunction with my wobbling, right? So I'll start maybe with a very small position at the first layer, then add a little bit bigger position at the second layer, and an even bigger position at the third layer. Because, as that pulls back, it will tend to find support at one of those layers. And so as I'm looking for that, the market's pulling back, add a layer here, right? The market decides to drop down, I'll be looking at adding a second layer at this point. Market drops again, has another leg lower, I'll be adding another layer at this point. So anywhere between the 0 and 100%, so 0 up here, 100% down here, 100% retracement would mean that the market drops 100% all the way back to here. So anywhere between the 0, I'll just put a big line there, or a big box there. Anything between 0 and 62%, anything in that zone between those two boxes there, I'm looking to take long positions. So I'll wobble all through that zone, just buying, and if I get little wobbles, little rallies in it, I'll take those off. If it drops back down, I'll add more positions on, but I'll take long positions all through that zone, right in there. And then as it breaks at 62%, let me just delete these real quick. If it breaks down below that 62%, then that's what I call my short zone. So this is short, and this is long zone. L for long, S for short, and anything between that 62%, and 100%. So this is 100% down here. Anything between 62 and 100%. Now I'm looking to close out of these longs, get into a short position. That's just probabilities, So the probability in this long zone is that the market will find support and reverse and move higher. Anything in this short zone between 62 and 100% retracement is the short zone, meaning it's not going to find support most likely, and that it will continue to go down all the way down to the start or the initial. It'll be a full retracement of the initial run. Does that make sense, everybody? So that's just a very basic model that I'll use in my trading, using the Fibonacci's as sort of my guideposts. Where am I going to be long? What zone am I going to be long in? And then where am I going to be short? Which zone am I going to be short in? The probability of 100% retracement increases after in this zone right here. The probability of a reversal increases in this zone right here. So reversal zone, full retracement zone down here. All right, let's just take a look at, clear this chart out and go back into history real quick and take a look at some of that in another perspective. Now again, nothing that we talk about in trading is a sure thing, right? It's all probabilities. So at that 62% retracement, you're just shifting probabilities from 51% probability that it's going to turn and move higher to now 49% that it's going to turn and move higher. So you're just changing your probability set ever so slightly down that retracement curve, if that makes sense. All right, let's clear this out. Let's take another look here. I'm going to clear everything. And let's look back at this last run, okay? So this last run in the market from here up to here. So again, eyeballing it, you would expect the market to have reversals somewhere in here, somewhere in here, somewhere in here. And if not in that zone, I drew that just a little bit off. And if not in that zone, then a full retracement all the way back down. Now so let's throw the Fibonacci on and let's see how close we eyeball it, right? So here's our Fibonacci. So there's one correlated area right here. I was a little off on that, but there's our second area, and then our 62% is right there. So somewhere in that zone, we would expect to find some support forming in that market, okay? So where then is our bullish zone and where is our bearish zone? Where are we going to take longs, build long positions, and where are we going to build into short positions? So what we'll do is we'll take the 100%, 0%, which is the top, drag a box all the way down to the 62% area right there. That's going to be our long zone. So we would build long positions in that zone. So L for long, right? And then as we drop down past that 62% retracement, then the probability is for a full retracement all the way back down to the initial point. So that's our short. So long in the top box, short in the bottom box. Now let's look forward and see how that all played out in the market. These are the three areas where we would expect some support to come into the market. So let's flash forward, look forward. Boom. Right there, we start to see some support off the 38%. We're gonna look and see if we find some support there at the 50%. Boom. It dropped all the way down, bounced off of that, right? The next layer is down here at the 62%. Boom, right there. Now this big wick breaks through, but it rallies all the way back up and you get the body close above that 62% retracement. So now if it breaks that 62% retracement, which it does right here, now all of our long bias, all of our opportunities to get into longs now kind of shifts, and now we're looking at a full retracement in the market. And it doesn't do that, a full retracement, but it comes close. So this is that third area that we were talking about that I disregarded on the previous one. It drops all the way down to that last one right there, which is it's the inverse of the 28% retracement there. All right, so now the thing here is that it's just a guide, right? This is just a guideline. Like, you're looking into the future. You don't know where this market's going to find its support. You don't know where it's going to make its reversal. And so you're using this as your guide to try and give you the idea, the area. Okay, it's not a specific, you know, when it hits that 23% or when it hits that 50%, I don't just jump into the market. I'm looking at it for a guide as to where that market might find support or might find resistance in where it's going. It's not a definitive. If you use it definitively, you're going to have a measure of success in the market. You'll win, you know, so many times out of 100. But if you use it as a guide, you know, and then use the wobble technique to kind of build positions around that area, then what you're going to discover is that it's a fairly effective tool at getting you in the right area at the right time. Not that you're going to perfectly time the market. You know, I gave up trying to time the market perfectly a long time ago, right? There's just not a lot of success in the perfect timing of the market. And so what I've learned to do in my trading is I've learned to say, okay, where is the area? What is the area? It's not a specific, you know, geolocation. It's not going to give you the longitude and latitude of where you're going to be in, but it's just that area. You're going to be in that area, and you're going to start to build those positions around that area. And then you manage, right? So if you're not correct, if your timing's not right on the first 23% retracement, then you kind of build into that next 50% retracement. If that's not right, you build into the 62% retracement. And any time you see that market rallying back in your favor, you peel off positions. You start to take a little bit of profit here, take off a little bit of losses there, and you start to manage that position. That's how you successfully build into a market that's how you successfully build into a position in the market. Here, and let's just address some of the questions that you have in there. We've talked a little bit about the model, right? Now let's go ahead and take a look at let's take a look at some of the questions. Do you go short until it hits the 100%, then take on long positions? So the question is you break that 62% retracement like the market did here, for example, right? It breaks that 62% retracement right there. Do you hold on to that short position all the way down to the 100% retracement? No, that you don't necessarily do that. In this case, you would have lost if you tried to hold on to that entire position. Again, it's just an area, right, and a probability. So you break the 62% retracement now. The probability is that you're going to get a 100% retracement. Okay, so that means that 52 times or 54 times out of 100 you get a full retracement, right? 62% of the time or 70% of the time you get another down leg, right? All the way down to that next layer that we didn't talk about in our retracement zones. And so it's just going to give you that slight edge in the market. Never would I hold on to it expecting it to go the full distance. If I start to see some support forming, if I start to see some turning in price action, yeah, then I close out of it. What I'm looking, you don't discount price action when you're trading like this, right? This is just a supplement to your price action and your read on the market. Your price and time cycles, they're still in existence, right? That market doesn't just in one candle drop from the 62% down to the 100%, right? It's going to use candles. It's going to have down candles, up candles. It's going to have turning points. It's going to have wicks. It's going to have all of those price action pieces as it works down towards the 100% retracement. And so you've got to work with the market through that process, right? And so if you've got price and time cycles that are hitting overextensions in between your 62 and 100%, well then you take a little bit off, you allow that market to rally back up, you add more positions, so you still trade it the way that you would normally trade it, building into these positions. You're just now got a slight bias or a slight edge to the downside in the market. Golden says, why do you not consider 78% last chance or last stand? That's really, this 78% is this one right here. I've just in my own, the way that I look at the market and the way that I model it. Now, you may be very different in how you look at it and how you model and how you see the market. But what I'm looking for is I'm looking for a bias in the market, okay? This bias that we talked about in here, long bias, short bias. And so as we cross that threshold on the 62%, that bias shifts ever so slightly towards the short side. And so that's why I'll build in, like, it wouldn't surprise me to find support at the 78% level. That you'll see that happen all the time. You'll see it stop like here. You'll see the market just kind of stop at some random spot, right? So that's not technically a Fibonacci ratio right there. So you'll see the market will do what the market wants to do, right? I'm just trying to build a bias for my trading direction. So anything above, and this is just my model, anything above the 62%, I've got a bullish bias. It will most likely find support above that 62. And then anything below the 62%, I'll have a slight bearish bias. So yeah, in a sense, it wouldn't surprise me to see the market turn at any given point. As a trader, I have to accept the fact that it can turn where it wants to, right? If I'm insistent and the market wants to turn, I'm going to be the person that's going to be wrong, and the market will be right? The market is always right. I have to respond to what the market does. So I build a model, say, as long as it's doing this, I do this. As long as it's doing that, I do that. And that's the model that I use in my trading. So there's going to be a lot of different numbers, a lot of different ratios that, people who are very into the Fibonacci, world, they're going to find all these really cool correlations. They're going to find some really neat, lunar cycles, possibly, 17th day of the month type things. You're going to find all these really neat, correlations in the market, and you're more than welcome to use them in your trading. What I'm showing you here is just a very basic model that you can use, that you can really eyeball for the most part, that'll give you some very basic bias rules in the market. All right, let's take a couple more questions here. Let's see. Do you ever use a time count measure tool looking for 144 candles between pivots? Bruce, that's a great question. You can apply these ratios to both the time element or to price element. So you can definitely use Fibonacci time tools to say, okay, the market should be making a turning point at this 44th candle, or whatever that is. That I don't particularly use that in my own personal trading, but there's a whole school of technicians that will look for those type of ratios in their trading. They're there, they exist, right? They're gonna have the same you're gonna have a probability model built with those time tools as well. What you'll see me use is what we call the time cycle, where we measure the distances between the short-term pivots, the time it takes the market to pivot, and you'll see me use that pivot time, that what we call the time cycle in the market. You'll see me use that occasionally as I'm looking at when is a good time to get in. You break that 23% retracement, it's going to take 3 or 4 candles, and oftentimes I'll say, okay, now I've got to wait for about 3 or 4 candles before we can get to the next layer where I want to build. And so you wait. Then that 2 or 3 minutes, 4 minutes comes up, the market's down on that next Fibonacci retracement level, which is also correlated with the support level. Now I'm starting to build a layer into the market. Giovanni, where can I trade in real life? Well, come to Apiary Fund. Go over to apiaryfund.com and sign up. That's what we're designed to be. Apiary Fund is designed to be in that void. There's a void in the market. Okay, you can go do a lot of learning on your own, and then you can go and open up your own account with all of your own money and risk everything, all your savings in the market. But there's nothing really that the market offers in between those two layers. The learn at your own and demo. Everybody offers a demo account. But what Apiary Fund is designed to do is designed to help you transition between the learning part and the doing part, right? So you come in, you go through this training session where you've got all of these, we call it the beeline to funding. You've got all of these quests that you have to go and accomplish, all these requirements you have to pass off. And in the process, you're learning how to do things in the market. You're learning how to build positions. Once you pass what we call the beeline to funding, then you get into what we call a funded account. Now you're actually trading real money in real market scenarios. And then, the Apiary Fund exists, to help. You get paid a portion of your profits. When you're using our money, we pay you a portion of the profit that you make while you're using our money. And we keep a little portion to help grow the Apiary Fund. So if you think about that continuum between, some random brokerage demo account and you trading your full hard-earned cash in the market, Apiary fills that void that exists in between those two layers. It's actually a really effective way to learn, sort of through our experience in the market. You can learn how to trade effectively on your own by using our system, by using our beeline to funding, and then getting into these funded accounts where you're actually starting to make a little bit of money and doing it for real in the market. Yeah, Apiary Fund is I really wish I could go back, 20, 25 years and find a company like Apiary Fund, because it's missing. It's a missing piece in the industry. It wasn't there when I got started, but it's a very valuable piece to help you get that transition between the learning and the doing it. So, all right, traders, let's just recap real quick. Fibonacci's. We're talking Fibonacci's today. The ratios, the Fibonacci ratios. This is the law of human nature. We see Fibonacci ratios everywhere in our life. Our eyes are accustomed to it. We look for them. When you build a house, you look at the ratios on the house. They're all Fibonacci ratios. It's just the natural way that we look at the world. And so it makes sense that we're going to see those ratios exist and form in the market as well. And sure enough, they're there. So, you know, in the beginning stages, you can use a Fibonacci tool to help you kind of know where those ratios are. Pretty soon, you're just going to get a good eyeball for it. Okay, where do those turning points happen in the market? Where are those ratios? Okay, once you have a pretty good idea of where those are, then you're going to start to build a model for yourself. You know, I always wait for the second, you know, the 38% or the 50% retracement. I always look for that. That's a model. That's how you're going to use those ratios for yourself, right? My model is anything. I'll look for long positions on a retracement. I'll look for long positions anywhere between 0 and 62%. So anywhere along that continuum, 23, 38, 50, 62, I'll be looking to build long positions through that area. Once it crosses down through that 62% retracement, then I look for shorts. You know, maybe I have to close out a losing position, but I'll start to look at how do I transition back into shorts now. So 62% all the way down to 100% is my short zone. At least if you're looking at a bearish retracement, at least on the market. And then of course the opposite is true for the bullish retracements. So that's just a simple way to kind of give you an idea. Number one, where are the most likely turning points going to be? You know, 23, 38, 50, 62. Those are the highest probability points on the chart. And then what's your bias? Am I going to be long or am I going to be short? Very simple. Again, it's not going to get you the right answer. It's not going to perfectly time the market. Don't look for it to do that. But look for it to build your model so that you can now trade at the higher probability places. And that's all we're really trying to accomplish in the market. So with that, good luck. I wish you the best of success. And
just wanted to announce Scott on your comments.
Scott. Oh, Scott. Hey, congratulations. I haven't even got the email yet. Maybe I did. I haven't seen it yet. But congratulations for getting funded, Scott. That's awesome. Make sure that you give this little video a thumbs up if you enjoy these and if you want us to keep doing them. Thank you, everybody.